Okay, welcome everybody. Welcome to this special lecture by a very eminent speaker, Governor Robert Holzmann. He's the governor of the Oesterreichische Nationalbank, which is the Central Bank of Austria, which is part of the Eurosystem of central banks. And in his capacity as governor of the Central Bank of Austria, he is also a member of the Governing Council of the European Central Bank, which is the body that is responsible for setting monetary policy for the entire euro area. So with all the excitement that we have seen over the last years in terms of inflation going up, lots of interest rate decisions, Robert has been there having a seat at the table and having a say on the decisions made. Now, Robert has a PhD in economics from the University of Vienna, and he has a long career in both academia and international organizations, including the OECD, the International Monetary Fund, and he spent more than a decade at the World Bank. He became governor of the Central Bank of Austria in 2019, and that was already before the pandemic, and that was already a very challenging time for monetary policymakers in the euro area, because inflation in the euro area at the time had already been persistently below the ECB's medium-term target of below but close to 2%. It was already a challenging time before the pandemic, and then, of course, the COVID pandemic hit, making things even more difficult. Then euro area experienced several months of deflation, in fact. Then there became a big increase in inflation. Within 2 years, actually, inflation rose above 10% even. And now inflation is back on its way down. So Robert has joined the Governing Council of the ECB at a really interesting time with a lot of challenges for monetary policymakers. So we are particularly interested in the topic that he's going to talk about today, which is monetary policy normalization beyond inflation. Because we have seen very unusual monetary policy during the pandemic. Lots of special measures, unconventional monetary policies, negative interest rates in the euro area already before the pandemic. Now much higher inflation, and inflation is now coming back down to more normal levels. So we're very much interested in finding out what Robert's views on what monetary policy normalization is going to be beyond inflation. Now, after Robert's presentation, there will be a Q&A, and after that, you're all of you very welcome to join for drinks in the Marshall Library in the social area. So please all join us, and we can discuss things further. So after the Q&A, first, we're looking forward to a very interesting lecture, and please join me in welcoming Governor Robert Holzmann.
Thank you very much for this kind introduction, and thank you for joining me here for a lecture, which is not a lecture in which I try to preach elements of the monetary policy, why we did it and what we have to do. On the contrary, I'm exposing to you a research agenda which I started with my team in Vienna in order to explore, in order to overcome of those constraints what we currently have. And so I'm happy to see your PhD students here, but also very happy to see a special person here, Mohamed El-Arian, because he was the person who worked together with him at the IMF, and we were together worked on Hungary in 88 to 1990, at a time before the Big Bang happened, during and afterwards. And the experience we had there, how to say, still something along what we still experience now. We hope we do the right thing, but whether really they work out, we will see. So what is the background of my talk? And it's the research agenda behind it, okay? The thing is, as it was said, we have high inflation nowadays. It comes down. How much it is, okay, let's assume it comes down to 2% again, our inflation goal. And then what? My granddaughter would ask, well, is it then we are back to what? I would then back the situation in which monetary policy may be constrained by the lower bound, by not being able to deliver fully unless, how to say, we use unconventional policy measures there. And are these unconventional policy measures good? Were they good? Can we change them? What are the kind of things we can do? This is the one part of it. So exploring what is the research agenda with regard to these unconventional policy measures, if and as our star remains low, even falls further. The second part, which I will enter only giving some of the headlines, is to say, well, if all the problem is with our star because it's too low, because currently it has increased perhaps, but at the end it will fall further, are there industrial policies we could apply in order to at least temporarily, perhaps permanently, increase our star in order to make our life as central bankers easier? And this whole research agenda is put down here. And the yellow ones I will talk about, 1.1.2 and 3.2.3. These are the most important ones. On the part of increasing our star, I give you a glimpse, because otherwise, if I would go into details, I would have to keep you for a few hours or a full year lecture. I won't do that, promise there. So let's move into the first part. Unconventional monetary policy, how should it work and what it actually did. The first part is the easy part. You might have heard about it, that life as a central bank in the past was relatively easy, because if you had overheating of the price developments, what could you do? You increase the interest rate or a set of interest rates. If, how to say, you had a pressure on the price level and you wanted to avoid deflation, you reduce the interest rate. And besides that, how to say, you had to think about, okay, do you want to work in a corridor system or in a floor system? Somewhat technical, we'll come back to that. And then, how to say, you had to determine in the old system, do I have to set a little bit money aside in order to deal with some of the financial instabilities? And if it's needed there, how much money do we need? And for this reason, reserve requirements were created. So banks had to put money aside with the central bank, and the money could be used in case of something happened. So bailing out a little bit. So this was the easy part. But if and as this equilibrium interest rate, this mystical interest rate, became lower and lower, there was the danger in order that the zero lower bound became binding, and then the question is what to do about it. And this was our fate over the last years, ever since 2007-9, ever the big financial crisis, and afterwards, we had difficulties with our normal instruments we had before to make a change, because the interest rates were low, but there were always a danger of deflation. So we had to do things which we didn't think were possible or which we didn't think were useful before. Now we had to do it. What was this kind of instruments we introduced? Number one was negative interest rate policy. When I was a student and I would have been in an exam and professor would have said, tell me something about interest rate policies, or they said, but the circumstances interest rate policy can be negative, I think I would have been out of the room immediately, simply impossible. Yes, we did it. Others say we introduced in countries negative interest rate, slightly, quite a lot of it. And this is something which, may have helped, how much we'll talk about it, but was not sufficient. We had to come up with other programs. Because with the interest rate, the negative one, we only try to control the short-term interest rate. But if the long-term interest rate was unchanged, the profile, interest rate profile over the term structure became even more steeper. But we wanted to have it, not steeper, but perhaps even flatter, for this reason, the idea, well, what about buying assets, in particular bonds, but also shares, in order to reduce the long-term interest rate? So this purchasing program emerged to buy a central banker on the market and in order to reduce the long-term interest rate. The third one was then having a special program to offer liquidity directly through lending programs to banking system. And different countries, different currencies applied different programs. In Europe, the most relevant one was TLTRO, targeted long-term refinancing operations, which at times, how to say, not only offered cheap loans to the banking system, which they should on lend to enterprise and households. We even paid them a subsidy in order to take these programs there. Banks are always a bit cunning, so what they found out, we can do a carry trade, so they take the loan and then put it on the banking account, so we earn 50 basis points, so it costed quite a lot of money, this interest rate there. And overall, there was the idea of forward guidance. Forward guidance, something mystical for monetary policy setters. Essentially, it is a kind of commitment technology. You commit to something, and if you are credible, you need to use less instruments in order to achieve the same objective there. And there's a whole literature about commitment technology which exists there. And the question is, was it working? And this applies to everything. But before we do this one, just a few glimpses there, because it goes over different currency areas there. You have here the monetary policy interest rates, and these are the ones which are relevant. So it is the relevant policy interest rate is mapped up there, but this relative interest rate policy changed over the years because it moved from the rate at which you could borrow to the rate on which, how to say, you received interest on the deposit there. The left side is the monetary policy interest rate, so the right-hand side is then the deposit rates, which you have there. You can see they became partly negative there. And then what you see there, which is typically not too much discussed in macro monetary lectures, is the question of a corridor system or a floor system. I don't know how much you go into the details there. A lot, good, perfect, because often it's neglected there. Because for a long time, a corridor system happened in which the rate on the market, as measured, varied between the deposit rate and the first lending rate there. And you have this green part of it, which showed the market rate, and the other was the policy rate there. And as time moved on, and as monetary policy had to rely on more and more low interest rate, as it shows there, we moved then from a corridor system to a floor system. But this was never decided. This happened by accident. So we never decided we moved there. At the one moment we were there. This is critical because currently, and you may have followed a bit the discussion at the ECB of those who did, was a decision recently, how do we get out of this? So this recently operational framework, which we decided about months ago or so, is a way in order how to live with it and what are the ways to move out of it. It's not immediately, but in 2 years when liquidity is reduced, what to do then. And the important part then on the right-hand side is that all of these policies, in particular the purchase program, but also the funding for financing programs on the right-hand side, how to say, increased our asset side of central banks, which is the upper part of it, but also at the same time the liability part of it. So a balance is a balance, what increases here, and it's also to increase here. And what one sees there, we really had this big opening of the balance sheet with a lot of liquidity thrown on the economy there. And the same applies not only to us, and we saw a number of other European counterparts. The same applies to the US. The difference is that for some time they tried to increase the interest rate, went back again. But what they have on the right-hand side, the same thing, the balance sheet increased from 1 trillion to 10 trillion, almost 10 trillion in no time. And this is the part of this ECB financing. This is this money given to banks in order to lend it on at cheap negative interest rates to households and enterprises. And what you can see here, in what speed it was increased, but also at what speed it could be reduced without creating havoc on the market. Because this was something which we were very much afraid, providing additional 2.2 trillion and then, taking things back. It worked out, which of course gives ideas for the future to use this kind of instrument more than compared to buying assets there. On the right-hand side, you see the asset purchasing program, of which the first one started to be returned last year, so not buying back actively, but not repurchasing. And our biggest one will start in a few months in summer and fully be implemented by the 1st of January next year. So these are the things, the objective. I gave you something about the magnitudes there to give a feeling how to say these were enormous amount of money, which none of us would have imagined about 5 or 10 years ago. But it said 5 or 10 years ago, this is the policy we want to do. Everybody would say, you're crazy, you're ruining the world, etc. We did it. Not only we, but also others. But then the question comes up, okay, how have they worked? What are the kind of intended effects? And afterwards, what are the effects we are currently able to say it has happened through statistical methods to make it happen? So I won't go to each of them in detail. Some of them you can easily imagine there, because otherwise we would use too much time. But the thing is, negative interest rates work as others. You know, if the interest rates go down, you have a cheaper price to pay in order to invest, to consume there. And this applies also on the negative side. You know, if you have an interest rate that is negative, that keeping the money and paying interest for them for keeping the money is expensive, so opportunity cost increase. So also it helps you somewhat to increase investments or consumption, but also it have a positive effects on the assets, because if a bond reduces the interest rate, the price of bond rises, also negative area. But then what you have also other effects which happen is the next slide. Forward guidance, I talked about it. This is the part of not spending a penny, but being convincing that you will do something, you will do it unless something changes. And if you are convincing, in this case, the instrument you apply may be less costly there. Quantitative easing, here the idea was, as I said, to change the structure of the term structure, and the loan subsidies was, how to say, to provide liquidity to the households in order to avoid any kind of liquidity gap. Now, but what are the side effects which happen there? Negative interest rate policy. What are the kind of things which may happen? There was a huge discussion on, it hasn't finished yet. Well, if you give cheap money to all the enterprises, what is one of the effects you think will happen? Well, enterprises that normally will exit from the market because they don't get money anymore, stay on the market. And this was then the zombie economies. I'm sure you should recall some of the papers there exploring, has this low-level interest rate policy, this availability created more zombie firms? And why is this important? Because zombie firms, they live further, they hold on the assets, human capital, financial capital, physical capital, and they don't allow the restructuring. So they are, in a Schumpeterian thinking, an impediment for productivity there. Funding for lending out of it, did it really work? Was this policy saying, okay, we give you cheap or negatively priced interest loans? Did it really help to increase the loan? The latest data for Austria, which my team has estimated, showed it wasn't really effective. It cost a lot of money, but the effect on the loan was not very high. Forward guidance. Here, the empirical estimates are difficult to do, but the effect, as far as I read it, not very high. And quantitative easing there, did it really affect the growth rate, or was it really able to, put more dynamism on the economy? Was it able, to lift the price level? Was one of the main reasons afraid of deflation? Well, the story is still out, but of what we did was, we're just finishing it, is to select the result was endogenous, 131 papers in journals, coming up from the best qualified then to a minimum level which had to be there, and putting them in a very tight analytical framework to measure it, and coming out then with the measurement there. And what you have there is the result there is measured. There are 4 effects: quantitative easing, forward guidance, negative interest rate policies, and funding for lending programs there. And then their effects on price stability, economic growth, financial stability, income distribution, and resource allocation. Red to the right, is positive, and blue is negative, or no effect there. And as you would see, it's a question now of how appreciation. Yes, there's some effects out. In most cases, they're positive, but in some cases, they're also negative there. So yes, we have these effects there, but it's not something which we would call effects which makes us very confident that if we have to apply it again, we have, found now the magic portion to work in a world of very low R star. So the main takeaways for a lot of work, so you get it in 5 minutes, but you can read it out here, is well, most of the theoretical effects conjectured in the paper, they're somewhat there. In some, but not all of the papers. But many of the papers also don't show significant effects, which is also a bit, astonishing, because you only typically publish a paper if you have an effect. No effect typically is, the results are biased. But this applies to the effects I noted before. For me, the interesting part is that the second part is that very little research has happened on effects which are nowadays very much in the newspapers there, or has been in London, in England, in Europe, everywhere. It's the prices of the housing. Because housing has become very, very expensive, and the political topic in all the countries there. But the effect of our generous liquidity-oriented policy on housing, on the wealth effect, and hence on the distributive effect, is not really there. And it has, of course, contributed to a lot of economic and political fallout on which we are still fighting with. But essentially, no research I'm aware of, I may have missed some important writings there, is to say, okay, what has been the effect on this liquidity overhang on inflation? You would say liquidity overhang on inflation? Well, if you are a more conservative economist, as I am, I still believe inflation is a question of, how to say, monetary overhang. If you have too liquidity in a system, it's a monetary phenomenon, inflation. And that it is true, BIS did a study last year coming out in which they made the point, if you aggregate the data space, it comes out 1 to 1, how to say, liquidity overhang creates inflation. But none of this is really part of any kind of studies there, because if it is true, what we would have, yes, we would be able to compensate their periods of low deflationary elements with unconventional monetary policy. It would be expensive. We would, how to say, be able to stabilize it. But at the end of the day, we would create inflation, which afterwards would have again to compensate by rising interest rates very highly. This is what we did recently. So we would be obliged to stay in a constant up and down. The question is whether we would like to have it. So, the result of it, for the time being, yes, we know these policies have been implemented, but they were not really game changers. If we have to do it again, then we will have, how to say, problems to become in a continuous circle in which the instruments will have to be applied, then taken back. We'd have inflation, and this inflation to be fighting would have to increase again the interest rate with all the problems involved. And one of the problems, I come back after the next section, which is the level and evolution of the equilibrium in interest rates. That's the one which, how to say, creates all this necessity to think about unconventional monetary programs. What is this A**, or A**s actually? Well, it's a theoretical construct, goes back to Excel, but also Meng and others have thought about it. It's essentially saying that's the interest rate in which allows us to have equilibrium, both at the price level, but also in employment, and also with regards to the growth there, and which serves as a measuring rod. If the economy is too hot, how to say, we have to go above this equilibrium rate. If the economy, how to say, is too low, we have to go below it. This is the part of it. Now, historically, and the estimates, or the history about the estimate is fascinating. The method by Williams, Lauterbach and Williams is now the standard method to do it. And here I have it only to 2019 on purpose, not to bring the COVID and post-COVID area into it because it's falsified. It shows that this rate is decreasing. Estimates, what you have here, you have the US mean estimates, the blue part, you have, we have the Lauterbach estimate with the confidence interval, and then you have also the green part, the non-US estimates, and what you find out, this all comes down. Okay, the reason why, we come back to that. But there's also another interesting phenomenon. You may have seen this graphic before, but it's fascinating, produced by the Bank of England, about this is not a theoretical concept estimated, these are real interest rates estimated through different stories and histories there, which shows that at the Middle Ages, down to 2011, there's essentially a linear trend why the interest rate is coming down. One can make fantastic stories behind it, and I work a little bit on it. I don't talk about it, I can. But it shows, but the thing is that if you use a traditional explanation for why A* is falling over the last 3 decades, and you apply this on the data of this estimated or estimated data there, it's not replicated. So applying our normal thinking why A* is low doesn't apply over the long run. For this, we have to come up with different stories. Happy to answer the question in this direction. But this kind of hypothetical interest rate is also replicated by real interest rate. But the left one is the ex-ante interest rate, so as the market estimates it, or as market assumption estimated towards the future. The right-hand side is exposed estimates for a number of countries. They all come down. And what you hear then is the question is, does it apply the same for advanced, for not advanced economy? Yes, there are differences there. You can even estimate it more deeply, which is the left part of it, where the red part shows the emerging economies, the blue part shows the advanced economies, and this estimate shows somewhat that the emerging economies still can run a relatively normal monetary policy. The advanced economies not really anymore. And what about China? Here's the short-term interest rate. We'll see it. Well, the variations become smaller, but the last of it, what also showed us, also China shows, this is also an estimate according to Williamson. And the right-hand side, if you try to analyze what makes the fall in China, also it is essentially the long-term growth factor. So built on this one, it looks like we're a little bit in a mess. That I would say we really have to think creatively, what can we do better about monetary policy, or can we do something about our star? Can we introduce policies in order to increase our star? However, my dear friend and colleague Isabel Schnabel has recently in a paper raised the question, you alluded to it. We have some indication that the short-term star may have moved upwards, so we may not be bound by this lower bound of interest rate. I'm skeptically against it, and in order to understand my skepticism, yes, it's true that's the short-term star, the one on which you have to somewhat sync your monetary policy, your short-term monetary policy, may have increased. My take is that this has more to do with monetary policy, not with the long-term effects, because if there's a short-term star, there must be a long-term star. And my take is the long-term star is dependent on long-term developments, productivity, demography. The short-term, well, the short-term will be somewhat to the monetary things. And what did we do recently? Well, we wavered in order to bring the long-term down, but in reality, maybe the long-term was constant, and what we did, we wavered with the short-term. So I would say this is a statistical artifact, but the story is out, but it's an interesting, fascinating topic to look into this econometric part. And on this, I finished now, but the big point is, at the moment, we don't know to what monetary future we can go, that we will have a re-increase, or we have, it's only temporary, so in the future we'll have to work again with unconventional measures. That's fine, okay, we'll work on it. However, and this leads to my third major part, is that this policy has also very unpleasant effects for central banker and for our balance sheet and for our profit and cost account and for the reputation of a central banker. Because you may say this is all due to monetary policy, but everybody will say, yeah, that's easy, you know, that's what he maintains. So what is the problem behind, and what is a possible solution there? And what it shows there is that at the moment we moved, as I said, from this corridor system to the floor system. Now we would up again, and what has happened is, recall what did we do in the periods of low inflation. We tried to pop up the system, we bought assets. What assets did we buy? Mostly bonds, not only. How much money did we buy at what price did we buy the bonds? At low, even negative interest rates. So these are now on our asset side of our balance sheet. So the biggest part there is assets which receive low or negative interest for the good performing countries. The less performing countries, they pay the higher price, so they still have some income there, but countries like Germany, Austria, we have essentially zero interest rates on our asset side. But what we did do now, as the inflation started to increase since 2011, so in 2021 and 2022, we started to increase the interest rate. The right-hand side, we increased the interest rate, and the interest rate in the floor system is the deposit rate. So suddenly, we had to pay the money which is in the reserve in our balance sheet. And who is the reserve there? It's the deposits of the banking system with us. We suddenly didn't have to pay them zero or negative. We had to pay them 4%. So we had assets, a lot, with no interest rates, deposits by the banking system with 4% interest rates. So a fully mismatch of assets and liabilities, which of course creates a major deficit. And so Germany Bundesbank had last year reported over 20 billion. We are 10% of Germany. We had a deficit of 2 billion there, and if the whole system and the ECB, 130, 140 billion, it's quite a lot of money. And what happens with this money? They show up as profits in the banking balance sheet, and the banks believe they earned it through their investment. The only thing what they did, they kept the money, which is a daily account, no risks involved for the daily account. You would like to have a 4% on a daily account with a risk involved. Yeah, exactly. They have it. You don't get it, I don't get it. So the question is then, what can you do now in order to change it? And what you have here is this is the expansion explained, and this is now, that's the first one. No, going back. So what can we do now in order to change the system there? Essentially, there are two ways of dealing with this. On the one hand is to tinker around with our purchasing program in the future. We could deal without, so not buying assets anymore, but only providing loans there. We could do other things there. We could increase the credit. We could change some of our unconventional monetary policy tools there. We would also move away from our corridor system, the corridor system back away from our floor system there. And we could also try different ways of our purchases there. But whatever we do, it's difficult to make it. The only way what really works is by increasing the reserve requirements. What does it mean there? How to say, as I said in the past, banks had to set aside up to 10 or even more % of their deposits as reserves, and couldn't use them to lend them out. And at the moment they were unremunerated, so they became a kind of a tax on the banking system, which of course the banks don't necessarily pay because they pass them on to the customer, enterprises, as well as households there. That's a very easy way of doing it. What is the willingness of countries of adopting them, the willingness of ECB I don't know about the Bank of England, but I know about the FED. It's close to zero, which means that I'm the one who's trying this horse for the time with limited success there. But if it's not the case, what may happen is that some banks may never become positive anymore. They will always have an accumulated negative account, so the equity capital will become more and more negative. In principle, this can always happen because we are not a central bank. But the question is whether you have confidence in a central bank which has an increasing negative account there. What does it mean to monetary policy? So this is one of our traumas, what we currently have, and we try to rescue. Happy to discuss some of the details there. But let me move now to my, so this is the, okay, this is the, it was later on, this is the part I wanted to go to, it was later in the slides. I was talking about it. Okay, so, as we have now a problem with A** because it remains low, as we have a problem because of the A**, the central bank scenery about financing looks negative. So what is our last hope, what we have now, is to say, well, aren't there elements we can find in order to make A* positive? What are the structural elements in order to make A* positive? In order to discuss this, of course, it's important to understand what drives A*, which is not easy, but there are two ways of looking into that, and there's a paper by the IMF produced for last year's economic outlook, World Economic Outlook, two working papers actually. The one tries to econometrically show what have been historically, sometimes since the 19th century, been drivers of A*. What has made A* smaller over time? Was it the demography? Was it public debt? Was it the profitability? Any kind of elements which you find out there. And the other part, which I find more interesting, which is still work in progress, we might just to say, let's build up a CGT model and with the assumptions try to mimic what the empirical results show and then play around in order to find out, oh, yes, such a model assumption could actually be the one which drives some of the real effects in reality. The second part is still underdeveloped, the first part is out here. And it would be fun now to go through it. We don't have the time, so I give you my storyline, what I think is the most important part of this elements there. You have the univert relationship there. On the right-hand side, you have over different periods of time who drove what. My take is, from an economic point of view, an interest rate, when you have it, needs to be financed by real events. It cannot be financed by something fictitious. And what is able to finance real interest rate in which you receive for earnings which you have to pay for, well, it needs to be created by total factor productivity, because it's the only element without additional resources to create a value added. There's nothing else there. So for me, fundamentally, total factor productivity is something which has it. So if there's no productivity, A* must come down. The second one is linked with it, but a bit older from the arguments, Samuels in 1958, saying, well, we have a natural rate, he also quoted, if the younger population is more populous than the older one, and this is means that, how to say, the younger one can pay a bit more to the older one without foregoing, how to say, an income effect. And this rate is also a possibility demographic growth or the growth of the labor supply is an element. For me, these are the big drivers there. So productivity growth, and labor force growth are the ones which, how to say, are the key elements. The rest help to think around, but are essentially secondary. But what are the kind of three elements of strategy I currently can envisage? And I will only go through the titles there in my last 5 minutes. The first one is to really work on total factor productivity, to work on what Schumpeter has called creative destruction. To say to have an enhanced process in which ways we did in the past change much more radically in order to create more value added without more resources for the future. It sounds great, so what could this be? Well, currently one of the biggest challenge what we have in front of us is quite likely environmental. It's the thinking about new ways in order to create energy, cheaper ways of doing energy. If energy would be very cheap, we could fully go into a recycled economy which would not use many more resources there. So the inspiration there is, and I fill a few pages there which I won't bother you with, is to think about what could be ways in order to encourage new energy generation findings about it, bring it together with ways how we invest and how we use this energy in order to make the next step of creating total factor productivity. Once it's there, it's not an effect we can do the whole time, but for the next 40, 50, 60 years, this would be a major possibility to contribute to a rising R star because total factor productivity has increased. We increased because total factor productivity has been pretty low over the last decades, and particularly the higher, the lower the has increased with higher rates, the lower the dynamism of an economy. The second part then is and this is something which is linked with my engagement throughout my life, retirement policies, is to think, what can we get out by making people enticed to have a higher retirement age? And this is, how to say, this Samuelson argument that you increase the labor supply there. And what are the magnitude about it? Increasing the retirement age, simply saying, tomorrow you retire 5 years later is a political no-go, but there are ways in order to entice it. And so the question is, how much quantitatively may we get out of it? And for this, I use estimates of the Austrian pension system. You find on the right-hand side the different passes there, and below you have the increase in labor supply there in a simplistic manner. The first one is to say currently the retirement age in Austria is 61 point something, but at this age we pay a major part from public resources in order to finance the system. Contributions are not enough. So the first part, let's increase the retirement age to the age in which the system is sustainable. This would be something like 68 years instead of 61. 7 years more, easily done, and well above this age. You can do it, don't worry. The second part is to say, what about increasing then the retirement age with the increase in life expectancy? So what are the maximum effects there? And the figures below here show you that for the first 20 years, you have 1.2, 0.9%. So over 2020, 2070, you would get 0.7% there. If this is also equivalent to the increase in R star, perfect. This is a way in order to to have a major contribution to our STAR to make life of the monetary policy easier there. And the last inspiration to work on is something which has to do with flows from the north towards the south, returning them to some extent. What has happened for many decades or centuries at least too, the flows from the north towards the south in order to inspire infrastructure, to build economies down there. But this flows has been substantially reduced over recent years. And there is a hypothesis of savings glut, how to say, and also if you recall the data, what we had there, it's a Bernanke, which showed about it, but also later on, I'm looking for the indication of the Lucas paradox, and why is the money flowing towards the north? I mean, that's a problem, I'll come back to that. But what you see there, and this is the data which I find highly interesting, is the upper part is where the money is coming from, and the lower part is where the money is flowing to. And what you find out is, and this has to do a little bit with the discussion we have nowadays on European growth versus US growth. Why is the US growing so much faster? What you see there is that Europeans, the UK, continental Europeans, we save a lot. All this money is siphoned out, but is used in the US. And this is part of the discussion about capital markets. If and as we're able to increase, keep, and are able to keep the money again here because we are more innovative, better able to create capital markets which are able to keep innovations within the country and not only finance them in the US. Those would be also possibilities to increase our STAR. But all this is, how to say, in the realm of future policy changes and looking what it is. For the time being, I think as central bankers, we have to be very modest, saying, I think we have to rework, refine some of our instruments there. This is the long term we have to look at. For the time being, we have to make sure that our balance sheet gets in order again, which is not easy. For the time being, we have to revise our policies, what we have there, in order to survive the next part of it, because otherwise we won't be able to make good for our main objective, which is financial stability and, of course, price stability. Thank you much for your attention. Thank you.